All right, guys, welcome back. And in this particular lesson, we're going to be talking about the advanced bat pattern. In the first lesson on the harmonic patterns, we talked about the Gartley pattern. The reason why we started with that is because it's very foundational to these advanced harmonic type patterns and advanced charting patterns that we're going to be learning, talking about, and so on and so forth. The reason why it's called the Gartley pattern, of course, is because H.M. Gartley actually came across it and wrote about it in his book, How to Profit from the Stock Market, back in the 1920s and 30s. However, he did not use the ratios of it. He didn't use the actual Fibonacci ratios. Now, we've talked about Fibonacci ratios, why they're so powerful and why they work so well, because they're found everywhere in nature, number one. Number two, I believe it's very psychological from a trading standpoint. I mean, you know, why is it that the finger there from the thumb on the tip of my nose to the top of my nose there, why is that the perfect distance there? I mean, that's how Fibonacci ratios work. So it's built into our DNA, so to speak. It's built into our nature. And I believe from a psychological standpoint, just from a mass psychology standpoint, you know, we're following the herd when we use these particular types of advanced patterns. And we talked about that with trend following and how we want to be followers of the trend. So in this particular lesson, we're going to talk about the bat pattern. Now, Larry Pesavento is a guy who actually began to use the pattern ratios with Fibonacci in his book called Trade What You See. He wrote about that. I recommend, especially after this coursework, that you go and read that book. It's a great book on pattern recognition and Fibonacci ratios and so on and so forth. So I recommend you get that. Now, the reason why we started with the Gartley pattern is because it's kind of the foundational pattern. The other patterns that we're going to talk about, the bat pattern, the butterfly, the Cypher, those are the patterns that we really focus on. The bat pattern is probably one of my favorite because of the reward to risk ratio that it presents you. It's different in the sense that it gives you a little bit better of a reward to risk ratio when it comes to your risk, especially your risk, than the Gartley pattern. So the bat pattern, the Cypher pattern, those are probably the favorite patterns that we use here and that we're going to be using quite regularly because of the reward to risk ratio that it presents. So essentially we're using ratios again. We're using the XABCD pattern type that we learned with the Gartley pattern. However, we're changing up those ratios slightly. So we're going to get into that right now. So this is a pre-drawn bat pattern on the chart that I've drawn. I'm using TradingView. That's what I like to use just by doing teaching, because it makes it very easy for me to move around the charts and for me to draw these particular patterns. But essentially what you're doing here is you are doing the same thing as you did during the Gartley pattern. You're getting that impulse leg, that X to A leg first. You need that strong impulse leg as the initial kind of precursor to this pattern developing. Once we have that strong X to A leg, then of course we're looking for a retracement, a pullback, and that's that A to B retracement. So the second thing you need is an A to B leg to be no greater than a 50% retracement of the X to A leg, right? So if we took a Fibonacci tool, just to kind of show you this, a fib retracement tool, and we drew that Fibonacci, we would want to see that stop at or near the 50%. We definitely don't want it to go down and touch the 618. If it stops there, breaks a little bit below it with the wick, that's okay, but we want that to basically stop there at the 50%. So it's a retracement from the X to A of the 50% leg, okay? So that's the first thing. The second thing that we're going to want to, or the third thing rather, after the impulse leg that we're going to want to see is the retracement from the A to B leg of at least 618, okay? So that means that from the A to B leg, so from here to here, okay, we're drawing an opposite direction Fibonacci. From the A to B leg, we want to see this C point, this retracement from B to C, we want to see that be at least 618. It can go higher as long as it does not break the ultimate high, the X to A impulse leg high. So that could be the high of the day or just the high of the move. If you're looking at a daily chart, obviously there are going to be several days in there. So it cannot break, even with the wick. If the wick comes up and breaks that X to A, that A point, high A point, in this case, this would be a bullish bat pattern. So if it breaks that high point, then it is an invalidated move, right? So this can go up even to, right up to it, right up to 93 or 94. As long as it doesn't break that high point of A, we're good to go. So the final thing that we're looking for then is a retracement. And this is where it is much different than the Gartley pattern in that we're now looking for a retracement from X to A. So the C to D impulse leg here, or the C to D leg here, is a much deeper than the Gartley pattern. We have to go down at least to the 886 level. It can go farther as long as it does not break this X point down here. So we don't want it to break the X point. So we would like to see that retracement hit at least the 88.6 level of the X to A leg. Okay, so it's an XABCD pattern. Okay, now when you do this on TradingView, all these ratios are drawn in for you, right? So we have the X to A, and then the A to B retracement we can see is at 50% right there. The B to C retracement here is at 615, and then we have the X to A retracement of the of 88.7 right here. So you can see that when you use this XABCD tool right here, and there's a number of different tools in here. There's a Cypher Pattern tool which we'll use in the Cypher Pattern video. So there is a number of different tools. We're looking at the XABCD patterns because we're talking about the Gartley, the bat, and the butterfly right now. When we get into the Cypher, we'll go to the Cypher pattern, and I'll show you that. All right. So let's look at some live examples now that I've got that drawn on the chart and kind of shown you what we need to see. I've also given you a cheat sheet of that that you can download. But I put this one right here in the center of the chart. I just want to get you used to seeing these with your naked eye. The more that you practice them, the better off you'll become. So we're going to start down here at the X point. And we're going to go the impulse leg up to the top of this move. Okay, so that's X to A. Now this is the daily chart, so that's over a number of different months. But I just want to show you how accurate this is, even on the daily chart. Then we go to the A to B leg. We can see that it's right there at 56.2. Doesn't go down to the 618. We're okay with that as long as it doesn't get down to the 618. Then we have a retracement here of the B to C level, or the A to B level rather. The C point is the retracement point. That gets up to 79.5. So we're happy with that. That's not a problem. Now, in this particular case, we don't quite make it to the 88.6 level, okay? The 88.6 is down here of the X to A, but that's a really huge move. We get to the 82.6. That's very, very close, especially for the daily chart. So in this particular case, because we had some other profit factors in alignment here, we had the candlestick pattern right here. Obviously, this is against the trend, and many of these patterns are going to be against the particular trend. In this case, we're downtrend in this at this particular point in time. But you can see here at that 82.6 level, we do have a reversal candle. I'm going to blow this up for you. We have an inverted hammer candle. And actually, I'm going to just show you some of these. Right here, the black one, we have an inverted hammer. It's also a bullish harami that we're looking at. You can see that black candle right there is within this candle right here, the real body of that candle. We also have a more basic pattern, which is a head and shoulders pattern. So here are the two shoulder points. Here's the head point. And then, of course, this is the neckline. And you can see that this is obviously changing direction here. We've also had a break here. At this point, we've had a break here of we've had a change here in our structure of the market. Once price breaks this point right here, we've had a change in the structure of the market. It pulls back, gives us another candle formation right here, okay? And then boom, it's off to the races. And you can see that this is a complete change or complete reversal in the trend right here. So this is one that was very, very close. It hit that 82.8 or whatever. And a lot of times, as long as it's good, it looks really good, we can take a small risk here. And then as this begins to turn around, we can add more onto this position. And that's how we multiply our profits when we do that. So that's one of them. Let's go ahead and look at another example. When we've got another pattern here on the EuroCAD. Again, it's right in the center of the chart, so you should be able to begin to see these particular patterns as we set them up. Here we have the X to A leg, impulse leg there. You can see that. That's the anchor leg. Then we have the first retracement, okay? That's the A to B leg. And you can see that it just gets right down almost to that 50% level and bounces back. Now we have the B to C. That hits a 79.7 retracement, and that's okay. And then finally, we have the A to D leg right here, and that hits 92.9, and you can see that this market now begins to change or begins to reverse at this particular point. Notice we have a number of different reversal candle patterns in this particular area. So we have one right here. Okay, then we have a bullish harami right here, another candle of indecision right here, a reversal type candle. This is a nice little pop right here. We didn't get quite all of the change in the trend there because the trend, of course, has been down here, and now it's moving, it's bouncing back and forth. But you can see that we had a nice little pop right here for a nice little move back up to the back into the Ichimoku, right up to the 200-day moving average. This is on the daily chart again. So again, we're going to see that, you know, it takes a while for the trend to usually change. And in this case, that's exactly what happened. So, and then you can see now the trend is kind of shifting back to the upside. We finally have a change in market structure here back to the upside. So this Euro CAD, we're looking for prices to begin to move upward and trend upward there. So, all right, let's look at one more on the Euro US dollar daily chart. Again, you should begin to see these patterns. You should be able to visibly recognize them very easily on the chart the more that you spend time looking for them and looking at them and practicing them. So first, we have the X to A leg here. We have the A to B leg here, okay? We have the B to C leg here. And finally, we have the C to D leg here. Now, we're going to see these ratios again. The X to A leg is the impulse leg. We have a 55.9% retracement to the A, from the A to the B leg. And essentially, it doesn't hit the 618, so we're okay there. Then we have the B to C leg. We have a 65.6, so at least gets to the 618 on that retracement. And then finally, we have the 88.3% retracement right here. Again, coinciding, and this is the key. This is what the profit factors really do for us. Besides just having these different patterns, once we have two or more patterns going together, a lot of times we're not going to have the trend involved in these particular types of patterns because they're going to be going against the trend. But you can see here, they're basically counter trend or reversal type patterns. So in this particular case, you can see the D leg right here. We had in coinciding with that, we had a reversal type candle pattern setup right here where we had a hammer right there, or pretty close to a hammer, and then the next day it dropped off really significantly here. And then you can see we bounced back all the way back to the Ichimoku before we finally had another reversal type pattern right there. So that's a nice little move, very low risk to reward there. Okay, so there's the risk. As a matter of fact, let's just go ahead and look at what the risk to reward was here. We can see that it's very, very small. If you put it above the D high right there, and all the way down here where we would finally exit this particular position, is about a 2.57 to 1 reward to risk ratio. And then in this case, we had another setup because price comes down. It's still, the trend is still up here in this particular case, right? Because we've broken structure and we're above the Ichimoku cloud. So right here, when price comes into the Ichimoku, this is a perfect place to buy this market again. So we had a nice little down move, and then boom, we bought the market again. So that's the way these patterns can really work for you and can really kind of differentiate you and give you an edge over just the average, regular, old trend follower or trend following type of a system or a trader. And that's why we use these particular patterns. So I put a cheat sheet here so that you can print that out. You can have that in front of you. You can see those ratios and you can begin to learn it and see those patterns and begin to recognize them a lot closer. We'll have many more examples in the weekly video section for you as well. So enjoy that, and we'll see you in the next video.